Welcome to the deep dive. In a world that's, increasingly fixated on green energy and sustainable solutions, it might actually surprise you just how indispensable a commodity like coal still is.
Uh-huh.
But here's the crucial distinction, one many often miss. Not all coal is created equal. For the global steel industry, specifically metallurgical coal, what we call met coal isn't just important, it's, well, absolutely essential.
Right. So it's foundational.
It is, quite literally, the foundation upon which modern infrastructure is built. Today, we're taking your sources and embarking on a deep dive to really distill the essence of two pivotal players in the U.S. metallurgical coal market, Alpha Metallurgical Resources, or AMR,
AMR.
and Warrior Met Coal, known by its ticker HCC.
HCC. Okay.
Our mission is clear. We're not just crunching numbers here. We're going to contrast their strategic approaches, their operational philosophies, and their distinct long-term visions within this incredibly vital, yet often misunderstood, industry.
Yeah.
Think of this as your shortcut to understanding the nuances, the things that really differentiate these two companies.
Sounds good.
And just a quick but critical note before we plunge in. For those of you tracking stocks, these companies' tickers can sometimes be, well, confusing. Alpha Metallurgical Resources trades as AMR,
AMR.
which you might think is American Airlines.
Right. Happens all the time.
And Warrior Met Coal is HCC, often mistaken for Western Asset Mortgage Capital.
Another common one.
So we'll be consistently using their correct tickers, AMR and HCC, throughout our discussion today, just to make sure we're all on precisely the same page.
Perfect. And building on that excellent framing, it's truly fascinating to see how even within a single, very specific industry like metallurgical coal, you uncover fundamentally different business models.
Right.
And different investment philosophies at work. We'll explore how each company navigates the often dramatic market cycles, how they strategically allocate capital, where they put their money, and how they position themselves for the future. We're pulling from a really rich array of recent reports and expert analyses you've shared with us, providing the kind of insight that hopefully cuts through the noise.
Exactly.
What we'll be asking throughout this deep dive is, in a world of evolving energy landscapes and shifting market sentiments, how do these companies not just adapt but thrive? And what does that ultimately mean for their long-term value and, the broader market?
That's the perfect lens through which to view this. Before we zoom in on AMR and HCC specifically, let's maybe broaden our perspective a bit.
Okay, the macro view.
Yeah, exactly. You might intuitively think coal is coal, but the story of metallurgical coal is fundamentally distinct from thermal coal, which is, primarily built for power.
Big difference.
This isn't about fueling power plants. It's about providing the very backbone of modern infrastructure, steel. Coking coal, which is the precise term for metallurgical coal, is a vital component in steel production, particularly in the traditional blast furnaces that, surprisingly, still account for about 70% of the world's steel output.
70% still? That's huge.
It really is. And here's where it gets, well, really interesting. And it's a connection many people, myself included until I looked at these sources, completely overlook. Steel is used in almost every component of renewable energy infrastructure.
Right. The irony.
Think about it for a moment. If we want more green energy, more wind turbines, more solar panels, more hydroelectric dams, we inherently need more steel.
You just do. There's no way around it currently.
Our sources highlight this with striking clarity. A steel pile forms the main component of a turbine in tidal energy systems, and it's essential for fabricating wave energy devices. For hydroelectricity, steel reinforces massive concrete dams. And, perhaps most prominently, almost every component of a wind turbine, from its foundational base to the towering structure, gears, and casings, is constructed with steel.
It's everywhere in green tech.
The irony isn't lost on us. If we're serious about expanding green energy, for now, we largely need metallurgical coal to make that steel.
Yeah.
To put a finer point on it, producing 1 ton of virgin steel typically requires around 0.78 tons of high-quality coking coal.
Almost a 1-to-1 ratio, practically.
Pretty much. And these blast furnaces demand the highest quality and, naturally, the most expensive type of coal available.
Exactly. You need the good stuff for that process. Taking that thought further, the demand for metallurgical coal is intrinsically tied to global economic growth and, crucially, massive infrastructure development.
Right. Makes sense.
We're not seeing a decline, but rather robust demand projections, particularly from developing economies. India, for instance, is rapidly expanding its crude steel production.
India is a huge factor now.
Huge. And it's projected to continue that growth trajectory, potentially stepping into a role as a major coal consumer, even if China's demand were to, say, experience a slight decline.
Interesting. So India picks up any slack from China.
Potentially, yeah. So despite all the global efforts towards greener alternatives, the long-term outlook for metallurgical coal demand appears stable, and maybe even growing over the next few years.
Okay. But what about supply? That's often the other side of the coin.
Exactly. And this brings us to a fascinating, almost paradoxical situation on the supply side, largely driven by the pervasive influence of ESG, environmental, social, and governance initiatives.
Ah, ESG. Always a factor.
Always. There's a compelling underinvestment thesis here. While demand is projected to grow, the ability to bring new supply online is heavily constrained.
Why is that?
Well, as one of our sources eloquently put it, nobody wants to touch coal because it's cold, it's ugly.
Blunt.
Yeah, but it captures the sentiment. This widespread ESG divestment by large fund managers, while often presented as environmentally responsible, frequently results in just a mere transfer of asset ownership.
So the mines still operate, just under different owners.
Often, yes. And from a pure environmental standpoint, it has no real environmental impact. What it does do, however, is severely limit access to capital for coal companies.
Okay, so funding dries up.
Precisely. Securing crucial financing, loans, or even essential insurance becomes an immense challenge.
Right.
It effectively strangles investment in new projects or even just maintaining existing ones properly.
Right.
And this leads directly to a powerful concept. Commodities don't die down, they die up.
Die up. Explain that.
What it means in practice is that as supply is curtailed due to this lack of investment, and as mines inevitably shut down, especially in regions like the U.S., where historically once a mine closes, it rarely, if ever, comes back online.
Right. They don't just restart them easily.
And not at all. So the persistent demand from legacy users and the growing needs of developing nations will inevitably drive prices higher. The commodity becomes increasingly expensive, creating market conditions that either force users to pay significantly more or push them entirely towards truly viable alternatives when and if they become available at scale.
So the constraint actually boosts the price for the remaining producers.
Exactly. This is a crucial point for long-term investors. Now, it's worth acknowledging a counterpoint. Some databases report up to 160 companies pursuing 252 met coal expansion projects globally.
Whoa, that sounds like a lot of new supply.
Theoretically, yeah, it could represent a 50% increase in supply. However, the reality is that many of these projects are likely to be uneconomical at current lower prices.
Ah, okay.
Or they simply won't materialize because of those very capital constraints we just discussed.
So the headline number might be misleading?
Very likely. It reinforces that underlying supply squeeze for actual delivered production.
So given this complex interplay of, steady or growing demand and this constrained supply, what does this all signify for met coal prices? This market is notoriously volatile, right? Known for dramatic swings.
Absolutely. Wild swings.
We've seen incredible highs, like that staggering $600 per ton peak back in 2022.
Yeah, post-pandemic and Ukraine war effects.
Yeah, triggered by those restarts and geopolitical shocks. But that was inevitably followed by significant pullbacks, bringing us to where we are now. Right now, market sentiment is described as temporarily negative. SP Global, for instance, revised down its met coal forecasts for both March and the full year.
Seeing that pessimism.
Prices have subdued to lower levels, partly due to, oversupply from good rains and mild winters affecting Australian producers who are major global suppliers.
Weather impacts, classic commodity stuff.
Yeah. However, here's an important detail not to miss. Even with this current downturn, what we're seeing as the new bottom for prices is still roughly 50% higher than where it was 5 years ago.
Interesting. So the floor has lifted.
It suggests an inflationary floor that wasn't there previously. This inherent volatility, though, underscores the critical importance of understanding the cost curve as a kind of, natural floor for prices.
Right, the cost of the marginal producer.
Exactly. Prices tend to bottom out around the 90th percentile of the global cost curve. And this cost curve itself is estimated to have risen significantly.
Inflation hitting production costs, too.
Looks like it. Our sources suggest the 90th percentile, which includes shipping costs for U.S. producers, is now around $240 per ton.
$240.
Okay, with the 75th percentile at about $215 per ton. For context, the average price over the past decade, even with all these dramatic swings, has hovered around $270 per ton.
So even the lows are higher than they used to be, and the average is still quite strong historically.
Yeah, it highlights the historical resilience of this commodity despite its often wild ride.
Okay, that sets the stage really well.
Let's shift our focus now to our first company, Alpha Metallurgical Resources, or AMR.
AMR, let's dive in.
If you've been reviewing your sources, it quickly becomes clear that AMR offers a more diversified and critically resilient posture within the cyclical industry.
Resilience is key in commodities.
Absolutely. This makes it an especially interesting choice if stability is, a priority for you as an investor. The company's journey has been quite remarkable. AMR experienced an astounding 238x increase.
238 times.
Yeah, rocketing from $1.90 in 2020 to a high of $452 per share earlier this year.
Incredible run.
Of course, the stock has since pulled back significantly from that peak, but that historical surge speaks volumes about its potential during upswings.
Sure does.
Looking at their recent Q2 2025 results, they reported a net loss of $5.0 million. Now, while a loss might initially sound concerning.
Yeah, you see loss and pause.
Right. But this was actually a significant improvement, especially when compared to the $33.9 million loss reported in Q1 2025. Their adjusted EBITDA came in at $46.1 million.
Okay, so sequentially much better.
Much better. And this performance was widely seen as not nearly as bad as anyone thought, and in fact was bordering on good given the prevailing macro weakness in met coal prices during that quarter.
Right, context is everything, beating expectations in a tough market.
Exactly. For you, the listener, this isn't just a number. It fundamentally highlights AMR's strong operational grip, showing an ability to weather tough times and manage costs effectively even when the market is against them.
That execution matters.
It really does. Even more positively, they achieved their best quarterly cost of coal sales performance since 2021 at an impressive $100.06 per ton.
Wow, under $101. That's strong.
Very strong. And this led them to lower their full year 2025 cost guidance to $107.7 per ton and also reduce their SG&A expense guidance.
So improving efficiency and outlook, good signs.
These were definitely welcome positive surprises for the market, signaling proactive and effective management.
It's precisely this resilience that I find so compelling about AMR. Their ability to maintain a strong position despite significant market headwinds is largely attributable to their diversified operational model.
Right, the diversification helps.
And their extremely prudent financial management. Operationally, AMR runs a substantial portfolio of 20 mines.
20 mines, that's a lot to manage.
It is. This extensive footprint offers a significant degree of diversification, acting as a natural buffer, and contrasts quite sharply with some peers that operate a much smaller number of sites.
Like HCC, which we'll get to.
Exactly. They predominantly use what's called room and pillar mining. This method is more adaptable to varying geological conditions and typically requires a lower initial capital investment.
Okay, so maybe less upfront cost.
Generally, yes. While it typically recovers less coal and is often considered less efficient than longwall mining in terms of pure output per section, AMR's management has proven adept at optimizing it. The recent Q2 2025 cost reductions, which were quite impressive.
Yeah, that $100 number.
Right. Those are primarily attributed to aggressive savings initiatives in labor and supplies. This clearly demonstrates management's keen focus on cost control and driving productivity improvements across their extensive and diverse operational footprint.
So they're good operators, even with maybe a less inherently efficient method.
Seems that way. And from a financial perspective, AMR has built an incredibly strong balance sheet, demonstrating remarkable fortitude.
Tell me about the balance sheet.
They've achieved significant debt reduction. Long-term debt plummeted from $551 million back in Q1 2021 to a mere $5.8 million by June 30, 2025.
$5.8 million. That's basically nothing for a company this size.
Practically zero. To put that in perspective, they're effectively sitting on a net cash position of $445.8 million, with total liquidity reaching $556.9 million.
Wow, huge cash pile, almost no debt.
Exactly. So what does this all mean for you as an investor? A significant cornerstone of AMR's strategy has been substantial capital returns to shareholders, primarily through massive share buybacks.
Ah, the buyback.
Massive ones. They've dramatically reduced their share count by 28%, and at one point bought back an astounding 60% of the company's shares for $1.1 billion.
60%? That's enormous.
It's huge. Management recently reinstated their buyback program, signaling a continued, unwavering commitment to enhancing shareholder value. This is a company that, once it generates cash, is clearly committed to giving it back to shareholders.
Okay, so shareholder return is a major focus.
Very much so. Another strategic advantage that truly sets AMR apart is its significant higher-priced domestic sales channel.
Domestic sales. How significant?
In Q2 2025, for example, 26% of their metallurgical coal sales were domestic, realizing an average of $152.28 per ton.
Okay, $152. How does that compare to exports?
It's notably higher than their export sales, which averaged $113.82 per ton for other export markets and $109.75 per ton for Australian index sales in that same quarter.
Big difference. So that domestic market provides a price cushion.
Precisely. This robust domestic channel offers crucial stability and acts as a strategic buffer, insulating them somewhat from the wild short-term volatility in international markets.
Makes sense. What about future plans? Any growth?
Looking to the future, AMR isn't standing still. They're investing in new projects, such as the Kingston Sewell mine.
Kingston Sewell. Okay.
A new underground mine in West Virginia set to produce highly desirable, low-volatile coal, with first production cuts expected in late 2025.
Ah, so moving towards higher quality coal, too.
Exactly. This demonstrates a continued commitment to investing in high-quality met coal assets. Furthermore, AMR owns a commanding 65% stake in the Dominion Terminal Associates, or DTA, export terminal in Norfolk, Virginia.
Owning export capacity, that's an advantage.
It's a distinct advantage, yeah. Offers greater control and efficiency in export logistics. However, it's worth noting that the majority of AMR's coal historically ships via rail, about 89% in 2023.
Rail, okay.
Which can be a more expensive option than barges, a method used by some competitors like HCC.
Right, you mentioned HEC uses barges, so that's a potential cost disadvantage for AMR on the transport side for export.
It can be, yeah. That's a point of differentiation we'll definitely delve into further when we compare the two directly.
Okay, great overview of AMR. Resilient, diversified, strong balance sheet, big buybacks, domestic buffer, but maybe higher transport costs for exports.
That's a good summary.
Now let's pivot to Warrior Met Coal, or HCC.
HCC, the pure play.
Exactly. This company represents a distinctly different kind of opportunity. A pure play focusing intensely on long-term growth, primarily driven by a massive, largely untapped project.
Blue Creek Project.
That's the one. To give you some context on their origins, HCC emerged from the Chapter 11 bankruptcy of Walter Energy back in 2015.
Right, came out of restructuring.
Yeah. Their current CEO, Walter Scheller, who also led Walter Energy, successfully steered the company through that incredibly challenging restructuring.
So experienced leadership that's seen tough times.
Definitely. And this deep firsthand experience has almost certainly instilled a profound focus on balance sheet strength and cost discipline within the company's DNA.
You'd expect that after bankruptcy.
You would. Acknowledging their recent Q2 2025 results, we did see revenue, EBITDA, and net income decline sharply year over year.
Expected with lower prices.
Right, directly attributable to the falling met coal prices we discussed earlier. Net income, for instance, was $5.6 million in Q2 2025, a significant drop from $70.7 million in Q2 2024.
Still profitable, though, even if down sharply.
Exactly, and that's the key point. Despite these undeniably weak macro conditions, Warrior was still turning a profit. This isn't just a silver lining, it truly demonstrates its ability to fight in the mud as an incredibly low-cost producer.
Fighting in the mud, I like that. Shows their cost structure advantage.
It really does. This resilience, the capacity to remain profitable even when the market is tough, is a key characteristic you'll want to consider when evaluating HCC against its peers.
It's exactly that ability to maintain profitability in a down market that makes HCC so intriguing, especially as a pure play company.
Right.
So how do they manage that, and what is the long-term potential fundamentally driving their strategy? A large part of the answer lies in their operational efficiency and their undisputed cost leadership.
Okay, break that down. How are they so efficient?
Unlike AMR's more diversified portfolio, HCC operates just two active underground mines, mine number 4 and mine number 7.
Just two active mines.
It's just two active ones currently. Both of these mines utilize highly efficient longwall operations.
Longwall, okay, contrast that with AMR's room and pillar.
Right. Longwall mining while requiring a substantial upfront capital investment.
Higher initial cost.
Higher initial cost, yes, but it's generally far more efficient and cheaper than room and pillar mining over the long run, contributing directly to HCC's enviable status as a low-cost producer.
Got it. More efficient extraction.
Exactly. In Q2 2025, their competitive cash cost of sales, FOB port, which for clarity means free on board the port, or the cost until the coal is loaded onto the ship, was an impressive $101.17 per short ton.
Okay, $101.1117. Very close to AMR's recent best quarter, actually.
Very close, yes. And for HCC, this was an 18% reduction year over year, driven by a highly variable cost structure, a disciplined approach to cost control, and overall superior operational efficiency.
Impressive cost control from them, too.
Very much so. Beyond their mining methods, they also boast a significant transportation advantage.
Ah, the barges.
The barges. HCC strategically utilizes three transportation methods: truck, rail, and barges. Their absolute key advantage and a crucial cost differentiator is the ability to ship met coal using barges through the Black Warrior River.
Black Warrior River, okay.
This method is consistently cheaper than both rail and truck transportation. Their favorable geographical location, directly linked to the Port of Mobile, significantly reduces their overall transportation costs compared to many peers, including AMR.
Right, who are mostly rail.
Exactly, giving them a structural competitive edge in export markets.
Okay, low mining costs, low transport costs. That's a powerful combo.
It really is. But the real long-term game changer for HCC, and a project that truly underpins its growth narrative, is the Blue Creek project.
Blue Creek. Tell us about this generational opportunity.
It represents massive, untapped reserves, which the company rightly calls a generational opportunity for sustained low-cost production for decades to come.
Decades.
Blue Creek is expected to boost HCC's annual production capacity by over 50%, adding approximately 6 million short tons annually once its longwall operations are fully ramped up.
6 million tons. Add that to their existing production.
Right. To put that in context, Warrior's other two active mines produced around 8 million tons in total in 2024. So this is an enormous increase in their overall output.
Huge growth potential then. How's the project going?
The project, critically, is ahead of schedule and on budget.
Always good to hear.
Always. With longwall operations now expected to begin in early Q1 2026, an acceleration from earlier projections.
So coming online sooner than expected.
Looks that way. The total capital expenditure estimate for Blue Creek is reiterated at $995 million to $1.075 billion.
So about $1 billion total cost.
Roughly, yes. With $823.5 million spent project to date by June 30, 2025.
Okay, getting close to completion then. What are the financial projections?
Financially, Blue Creek is projected to significantly lower production costs for HCC even further, and it has a net present value, or NPV, of over $1 billion even at lower met coal prices.
NPV over $1 billion. Explain NPV quickly.
Sure. NPV is essentially the estimated present-day value of all its future cash flows, so it highlights the project's immense long-term profitability and value even today.
Got it. So it's expected to be highly profitable.
Very. This truly positions HCC to be a dominant, low-cost supplier to the global steel industry for decades.
Okay. What kind of coal will Blue Creek produce? You mentioned HCC historically had premium coal.
Good question. Historically, HCC has produced a very high proportion of low volatility, or LV, coal.
The best stuff.
A highest quality, most valuable grade, yeah. Higher carbon content, more coke per ton. This premium product mix has consistently led to HCC's average realized price generally being higher than its competitors, often commanding that average premium of 21% to 30%.
Significant premium.
Very. However, as Blue Creek comes online, it will produce premium high-vol steelmaking coal. Still premium, but different.
High vol A. Okay, so not the top-tier LV coal.
Right. Management expects the share of LV coal in HCC's overall production mix to decline to 39% by 2027 as Blue Creek fully ramps up.
So the mix changes quite a bit.
It does. This implies that while still producing high-quality coal, HCC's realized prices and margins might normalize closer to peer levels going forward, rather than consistently commanding that historical top-tier premium.
Interesting. So volume goes way up, costs come down, but the average price premium might shrink.
That's the expected trade-off, yes. Now, in terms of capital allocation, HCC presents a stark contrast to AMR.
Oh, so?
Unlike AMR's focus on immediate share buybacks.
Right, AMR giving cash back now.
HCC has been prioritizing growth. They have been investing significant capital expenditure into Blue Creek, which has temporarily reduced their ability to return cash to shareholders through dividends and buybacks since 2020.
Okay, so plowing money into the new mine instead of buybacks.
Exactly. The strategy here is explicitly to invest in growth now to explode cash flows on the upside
Yeah,
later.
explode cash flows. Sounds promising.
The projection is that once Blue Creek is fully operational and sustained capital expenditure on the project winds down, HEC could realistically generate $500 million in free cash flow per year.
$500 million a year. What kind of yield is that?
That represents a truly impressive 20% free cash flow yield by 2027-2028.
20% FCF yield. That's massive potential return down the road.
It's a powerful long-term vision, and their balance sheet supports this. It remains remarkably strong, with $383.3 million in cash and cash equivalents, and only $154 million in long-term debt as of June 30, 2025.
Still very strong financially, even with the Blue Creek spending.
Very. This robust financial position allows them the flexibility to fund Blue Creek without undue strain. Looking ahead, management believes current met coal prices are too low for many operators.
Right, the cost curve idea again.
Exactly. They're expecting a wave of supply rationalization through mine closures or production cuts across the industry.
Which helps the low-cost guys like them.
Directly benefits low-cost producers like HCC by reducing global supply and helping stabilize or even push up prices. Finally, there are those recent legislative changes.
The One Big Beautiful Bill Act.
That's the one, signed July 4th, 2025. It designates metallurgical coal as a critical mineral.
What does that designation do for them?
It's a significant tailwind. It potentially qualifies HCC for a 2.5% production tax credit under Section 45X. That's a specific provision for critical minerals on production costs for 2026-2029.
A tax credit on production costs, how much could that be worth?
It's estimated at an annual cash benefit of $30 million plus for HCC.
$30 million plus a year, just from that. Nice.
Yeah. Additionally, a 33% foreign income deduction for international sales will benefit HCC significantly as substantially all its production is exported.
So lower taxes on their export profits too.
Right, further bolstering its profitability from global sales.
Okay, so for HCC, pure play, low cost, huge growth from Blue Creek coming online soon, potential for massive future free cash flow, strong balance sheet, and now these legislative tailwinds, but maybe less price premium going forward.
An excellent summary of the HCC story.
So let's bring these two titans into direct comparison now. After delving into AMR and HCC individually, what emerges is, well, a clear understanding that choosing between them comes down to a fundamental trade-off in investment philosophy.
Definitely different approaches.
They represent genuinely different strategic approaches within the met coal industry, each with its own compelling set of strengths and distinct risks. For you, the investment thesis for AMR centers squarely on its more diversified and resilient posture.
Stability and resilience.
Right. You're looking at a company that offers the added stability of that significant higher-priced domestic sales channel, which acts as a crucial buffer.
The domestic cushion.
Its operational flexibility, spread across many mines, provides a strategic cushion against short-term volatility in the international markets. Their focus is clearly on returning capital to shareholders through consistent and aggressive share buybacks.
Cash back now.
Almost strapping themselves to the wheel of delivering immediate cash returns.
Yeah, that seems to be the mantra.
On the other hand, HCC presents a powerful long-term growth narrative.
Growth is the key word for HCC.
While its pure play model and heavy reliance on exports inherently make it more susceptible to global market fluctuations.
It is more exposed to price swings.
Its deeply entrenched low-cost structure and the immense future potential of the Blue Creek project position it for substantial long-term value creation.
Betting on the future payoff.
The strategy for HCC is a clear bet on significant growth capital expenditure now, with the expectation of unleashing explosive future cash flows and shareholder value down the line. It's that classic dilemma, immediate returns versus future growth.
Exactly. And if we put this into a broader context, the differences are quite stark across several key operational and financial aspects, which ultimately inform very distinct risk-reward profiles for each company.
Okay, let's break down those key comparisons.
First, let's reconsider their operational style and underlying cost structure. AMR, as we discussed, operates a larger portfolio of 20 mines, largely employing the room and pillar method.
Flexible, but maybe less efficient inherently.
Right. Offers flexibility, but generally considered less efficient in pure extraction than longwall. Despite this, management demonstrated a notable ability to drive down costs in Q2 2025, proving their operational prowess.
Good operators matter.
They do. HCC, in contrast, operates fewer mines, 2 active and 1 in development, but primarily utilizes highly efficient longwall operations.
More efficient mining method.
Inherently, yes. This efficiency, coupled with their cheaper barge transportation through the Black Warrior River to the Port of Mobile,
The transport advantage again?
contributes significantly to its status as an exceptionally low-cost producer. This prompts a crucial question for you. Does AMR's proven ability to manage costs effectively across a larger, more diverse, but inherently less efficient footprint outweigh HCC's inherent structural advantages in both mining technology and logistics?
Good question. Operational skill versus structural advantage.
It's a key point of differentiation.
Yeah.
Second, let's look at their production mix and how that translates into realized prices.
Right, the quality of the coal.
Historically, HEC has had a higher proportion of premium low volatility, or LV coal, the highest quality product.
Leading to that price premium.
Exactly. Consistently higher realized prices, often that 21% to 30% premium over peers. However, the Blue Creek project, while massive, will introduce a higher volatility HVA mix.
The new mine's output.
Right. And management has guided that the LV mix will decline to 39% by 2027. This could potentially normalize HEC's future price realizations closer to peer levels.
So the premium might fade.
It might shrink, yeah. AMR, while historically realizing lower prices than HCC, is actively developing new, low-volatile mines like Kingston Sewell,
Moving up the quality ladder themselves.
indicating a strategic move towards increasing its own proportion of higher quality, higher priced products. So the key is to consider how the future blend of coal grades will impact that premium story for both companies. It's becoming more dynamic.
Okay, so watch the product mix evolution for both.
Definitely. Third, their capital allocation and approach to shareholder returns present a very clear investment choice.
AMR buybacks versus HCC growth spending.
Exactly. AMR has demonstrated an unequivocal commitment to reducing debt to near zero and consistently returning capital to shareholders through aggressive share buybacks. They've effectively strapped themselves to the wheel of generating cash and giving it back.
Cash out now.
HEC, conversely, prioritizes massive capital expenditure into growth projects, most notably Blue Creek. This means lower immediate shareholder returns, fewer dividends or buybacks in the short term.
Investing for the future.
But it's all driven by the expectation of exploding cash flows and substantial returns once that capital expenditure winds down, with that potential 20% free cash flow yield by 2027-2028.
Huge potential payoff later.
This is a classic buyback now versus growth for future buybacks scenario. Your preference here truly depends on your investment horizon and your appetite for growth-related risk.
Short-term versus long-term focus, essentially.
Really much. Fourth, let's evaluate their market exposure and resilience.
Domestic versus export focus.
Right. AMR benefits from its diversified portfolio of mines and, as we highlighted, that significant higher-priced domestic sales channel, which offers greater stability and a buffer against the sharper swings of international market volatility.
More insulated.
Somewhat, yes. HCC, as a pure-play exporter, is more highly susceptible to global met coal price swings.
More leverage to global prices, up or down.
Exactly. While it enjoys advantages in export costs, it's also more exposed to international market dynamics and potential geopolitical factors or tariffs. For example, in Q2 2025, they had no coal sales to China due to retaliatory tariffs.
Oh, right. That's a risk.
Though they successfully found other Asian buyers, it just highlights their reliance on diverse but entirely export markets.
Got it. Exposure difference.
Finally, both companies are set to benefit from the designation of metallurgical coal as a critical mineral.
The legislative tailwind.
Right. The One Big Beautiful Bill Act and the Section 45X tax credit offering 2.5% of production costs for 2026-2029 is estimated to provide significant annual cash benefits. $50 million for AMR and $30 million plus for HCC.
So a nice boost for both bottom lines.
A definite boost. Additionally, both will benefit from that 33% foreign income deduction for international sales, though HCC, being almost entirely export-focused, could see a larger relative impact from this particular tax benefit.
Makes sense. More foreign income, more benefit from the deduction.
Exactly. So those are the key comparative points.
Excellent breakdown. Beyond their individual strategies and comparative strengths, though, Both AMR and HCC operate within a complex industry that's facing unique, powerful headwinds and tailwinds.
Yeah, the industry context is crucial.
These are the broader forces that significantly influence the playing field for all metallurgical coal producers, regardless of their specific operational choices.
Indeed. And what's truly fascinating here is how these broader trends, which often appear to be risks, can simultaneously create unexpected opportunities for companies agile and intelligent enough to navigate them.
Okay, like what?
First, the omnipresent ESG landscape continues to be a major factor. Due to the combination of stringent ESG regulations and widespread public sentiment, coal companies face immense challenges.
We talked about the funding issues.
Right. Securing crucial financing, loans, and even basic operational necessities like insurance. This persistent lack of capital access, paradoxically, severely constrains the development of new supply,
Which supports prices.
which, over time, ironically supports higher prices for existing producers. As one source noted, the truly intelligent investors recognize that their capital allocation decisions, while financially driven, have no real environmental impact on existing operations. They focus on risk-weighted returns.
Rather than ideology.
Right, rather than succumbing to what can be described as nonsensical ideology. Then there are the profound labor market dynamics at play.
Labor. Always tough in mining.
Incredibly acute. The industry-wide struggle to attract and retain skilled labor is intense. Labor inflation, as one source put it, has gone absolutely bonkers.
Bonkers. Strong word.
Yeah, making it dramatically hard to attract and keep skilled workers in an industry that is often perceived as volatile and, well, less glamorous.
You mentioned seeing hiring billboards far away.
We even saw billboards for Warrior Met Coal, advertising for hiring in Alabama, way up in West Virginia where Alpha Metallurgical Resources operates. It underscores this intense cross-state competition for talent.
Wow. Fighting for workers everywhere.
And on top of that, general productivity is declining in both U.S. and Australian mines, making the actual extraction process more costly and challenging, intensifying the need for efficiency at the operational level.
So costs are pressured by labor availability and productivity, too?
Definitely. We also need to consider the undeniable evolution of steelmaking itself. Electric arc furnaces, or EAFs.
EAFs, the alternative to blast furnaces.
Right, they use electricity and scrap metal, and they're gaining traction, especially in the US and Europe. They're appealing because they emit about 70% less CO2 than traditional blast furnaces.
Big environmental benefit, but limitations.
Significant limitations. They are only cost-effective when there's abundant, reliable, and relatively cheap electricity.
Which isn't always the case.
Not always. More importantly, they cannot produce virgin steel from raw iron ore. They require scrap metal.
Virgin steel, why is that important?
Virgin steel, known for its consistency and strength, is absolutely critical for precision industries like automotive and aerospace, as well as for high-stress applications such as major bridges and skyscrapers. You need that primary steel.
Okay, so EAFs can't replace blast furnaces entirely if we need virgin steel.
Not with current tech, no.
Yeah.
Also, a region like Europe currently lacks a well-developed scrap market. So a full transition to EAFs would necessitate massive scrap imports, which would inevitably drive up costs.
Logistical and cost hurdles for EAFs, too.
Right. So instead of a sudden dramatic shift, we're more likely to see a gradual transition, perhaps through hybrid technologies that might use both hydrogen and a reduced amount of coal.
Interesting. Hybrid approaches.
And what's being termed a two-tier market, where some regions maintain coal-based production longer. It's a huge undertaking. It's going to take 15 to 20 years just to build a comprehensive hydrogen infrastructure network in Europe alone.
15 to 20 years, that's a long transition.
It's very long. This leads to a critical insight. While EAFs certainly present a long-term headwind, the persistent need for virgin steel and the immense logistical and infrastructural challenges of a rapid wholesale transition mean metallurgical coal demand is likely to remain firmly supported in the short to medium term.
So met coal isn't disappearing overnight.
Not even close. The physics of the transition are slow. Finally, we cannot ignore the ever-present political factor.
Politics and coal always linked.
There's clear political pressure against coal, exemplified by policies from the Biden administration and EPA regulations, which could, for instance, lead to the potential shutdown of thermal coal plants by 2040 without cleaner installations.
Pushing away from coal.
But ironically, such policies, while intending to phase out coal, also inadvertently reduce the overall supply.
Which could lead to higher prices again?
Potentially, yes, for the remaining users. As one expert observed, the thermal coal market is setting itself up for that again, highlighting a similar dynamic unfolding in that sector.
Interesting unintended consequences. What about a change in administration?
Well, a potential Trump administration win, according to sources, would really galvanize morale because guys are not going to worry for their jobs like they would otherwise, potentially alleviating some regulatory pressures.
So maybe less regulatory headwind.
Perhaps. However, even with political shifts, the fundamental physics and economic realities of energy transition mean that these are complex, long-term shifts that will unfold at a gradual pace, regardless of who is in office,
Politics can influence, but physics still rules.
ultimately.
Okay, so after this deep dive, what does all this mean for you, the listener? We've meticulously explored Alpha Metallurgical Resources and Warrior Make Coal, dissecting their unique strategies and positions within this, well, ever-evolving metallurgical coal market.
Lots to consider.
Definitely. The choice, for you, often boils down to a fundamental question of investment philosophy. Do you lean towards AMR's diversified, resilient approach, with its strong domestic sales channel offering a degree of stability and its consistent focus on returning capital to shareholders through aggressive buybacks?
The stability and immediate return play.
Or are you drawn to HCC's pure-play, growth-oriented strategy, betting on the massive, long-term transformative potential of projects like Blue Creek to eventually unleash significant cash flows and shareholder value?
The long-term growth and future cash flow play.
Both companies operate in a truly fascinating industry that, despite its often maligned reputation, is undeniably indispensable for global steel production and, perhaps surprisingly, for the very infrastructure that underpins our renewable energy future.
Still essential despite the narrative.
Their ability to adapt to ongoing ESG pressures, navigate complex labor challenges, and respond to technological shifts in steelmaking will ultimately define their future paths.
This brings us to a compelling thought for you to carry forward. In a world where the energy transition is driven by both policy ambition and the stark realities of physics, and where traditional commodities are being fundamentally reshaped, how do you personally weigh the immediate tangible benefits of consistent capital returns against the long-term, potentially transformative growth potential?
The core trade-off.
Especially when both are underpinned by an essential but often misunderstood resource like met coal. As we've seen, the met coal market is highly cyclical, characterized by dramatic swings. We might be near a cyclical bottom, but the precise timing of the next boom is always uncertain.
Nobody rings a bell at the bottom.
Exactly. So what historical patterns or long-term structural shifts like the ones we discussed today can you identify that might guide your thinking in such a volatile yet undeniably essential sector? Something to ponder.